Hello everyone, thanks for checking out my video. The S&P 500 has hit all-time high for the 45th time last week, registering a 5th consecutive week of gains. This came after the major financial institutions reported decent quarterly earnings to kickstart the new earnings season. But there seems to be some risks that are brewing below the surface, with CPI and jobless claims coming in hotter than expected. If inflation and unemployment rate go up together, it only spells trouble. Will this really happen? Well, let's discuss a bit more in this video. The usual stuff, do watch on to find out more. The Wall Street kick-started the earnings season with S&P 500 hitting all-time high again, as major financial companies rallied after posting solid performances. The S&P 500 crossed the 5,800 milestone for the first time ever and clinched its 45th record high in 2024. The latest rally also saw the index gaining for the 5th straight week, its longest winning run since May this year. Anyway, on the earnings front, JP Morgan Chase, the biggest American bank, rose more than 4% after beating profit and revenue estimates. Wells Fargo popped more than 5.5% as they reported better than expected profits. And then we had BlackRock, an investment firm, rose more than 3.5% after it reported its assets under management had hit a record high for the third straight quarter. Additionally, its earnings had surpassed investors' expectations as well. All these solid quarterly earnings seem to have brushed off the earlier hotter than expected CPI reading and jobless claims data. So basically, earlier in the week, the CPI for September showed an increase of 2.4% year over year, above expectations of 2.3%. Month over month, CPI rose 0.2%, which is also higher than the estimate of 0.1%. In terms of jobless claims, 258,000 people filed for unemployment previous week, the highest we have seen this year, and this number is above the market expectation of 230,000. In case you don't know, hot inflation and rising unemployment means trouble for the economy. That had obviously soured the sentiment of the stock market on the day when the reports came out. But as mentioned earlier, towards the end of last week, the market rallied after the major financial players reported decent quarterly earnings. Finally, elsewhere, Tesla's share price plummeted close to 8.8% on the back of an underwhelming robotaxi event. The event was described by many as a disappointment due to a lack of details in many areas. For instance, the regulatory roadmap, the go-to-market strategy, and how is the company going to compete against ride-sharing companies such as Uber and Lyft, etc. Interestingly, as Tesla's share price plunged, shares of Uber and Lyft jumped more than 9.5%, probably because investors felt that Tesla's cybercab is not threatening or disrupting the ride-sharing industry yet, at least not for the next 2 to 3 years, given how infamous Elon Musk is in missing timelines. Wow, that was a long recap of last week's happenings. Okay, moving on to market outlook for this week. In terms of the upcoming week, it's all about the third quarter's earnings reports. The new earnings season continues in full swing, with financial institutions leading the way again. Some of the names to watch include Bank of America, Citigroup, Goldman Sachs, and Morgan Stanley. In addition, there are also non-financial mega-cap companies reporting their earnings this coming week, which includes Netflix, Johnson & Johnson, TSMC, and ASML. Another thing to watch this week would be Thursday's retail sales report. The past few retail sales reports have been stronger than expected, so the upcoming data point will provide a good read on the state of the US consumers. Let's move over to the technical analysis section. First up, do you recall that I said in my previous video that SPY could possibly hit a new all-time high last week? And it did, twice in 1 week. I also mentioned that at all-time high, the next meaningful resistance is at around 580, and guess what? SPY kissed 580 and retraced a little bit. So for this week, watch this 580 resistance level closely again. If we can close above it with good volume, the next resistance level lies at 592. Just to add, there are two positive signs for the bulls. First of all, SPY has broken out of the bull flag. That's obviously bullish. Next up, MACD just had a bullish cross last week. So there is a decent probability of SPY hitting another all-time high again this week. Not financial advice, okay? On the other hand, if I am wrong and if SPY gets rejected at 580 again, then watch for the two key levels below, and they are 571 and the 563 to 565 support zone. Honestly, breaking below 571 isn't that bad, but breaking below the support zone is something that is worth paying attention to, because when that happens, I would say that the bearish divergence on RSI is playing out. Further bearish momentum could bring SPY towards the 50 moving average at around 555. This is one important level to watch, because this is also where the critical 61.8 Fibonacci level sits. If this level breaks as well, then we can say that the broader market is bearish, and that will get me excited. The reason is because for SPY to drop from the current price level to 555, that's about 4% decline. It is so rare to see a 4 to 5% pullback these days in SPY, making it difficult for me to pick up shares. Therefore, if it really happens, I would be standing by my shopping list. Okay, moving over to Apple. For 2 consecutive videos, I have said that Apple is in no man's land. Unfortunately, I have to say the same thing again this week, because Apple is still trading sideways between the range of 224 and 233. Personally, I think Apple is lacking catalyst to move in either direction. But one positive note for the bulls is that Apple is floating nicely above the 50 moving average. Last week, it did briefly fall below 224 and the 50 moving average, but bounced back up quite quickly. But again, it is not showing any clear momentum yet. For us to call Apple bullish, it obviously has to break above the consolidation area, which means going above 233. By doing so, that will invalidate the bearish double or triple top patterns, depending on how you read the chart. On the other hand, if Apple breaks 224 and the 50 moving average and don't climb back up quickly, then it is bearish. That is when we can be almost certain to see Apple trading below 220. From there, I wouldn't be surprised if the gap between 216 and 217 gets filled. But with all that said, so long as Apple stays above the critical 61.8 Fibonacci level at 210, all is good. It is only when that level breaks, it will likely open the floodgate to the downside with low 200s range in sight. Let's now jump over to Tesla. Sorry, I had to bring back this recommendation by Goldman Sachs on buying Tesla call options ahead of Tesla's delivery numbers and robo-taxi event. For 2 consecutive videos, I shared that this recommended move by Goldman is fishy, and 2 videos ago, I specifically shared that they could be the ones selling the call options to you. Well, since Goldman made that recommendation on 25th September, Tesla has fallen from 257 to 217. This 40-point drop is a decline of 15.5%. I guess their recommendation didn't age well for investors who follow it. This also shows that when big institutions gave such precise recommendation, it is best to be skeptical about it. Anyway, it's quite obvious that Tesla's robo-taxi event didn't impress investors. My personal view is that the overall robo-taxi plans from Elon Musk, the Cybercab, the Robovan, the humanoid robot are impressive, but only on paper. As mentioned by Elon Musk, the autonomous car is expected to be out before 2027. But if you are a long-term follower of Tesla, you would know that his timeline always gets stretched. So I think we could be looking at 2028 or maybe even 2030. Therefore, to a lot of investors, if the Grand Master Plan is only going to be materialized after 2027, they'll be like, why don't I sell the shares now and then hop back in again in 2026 or later? Apart from the timeline, many investors are also criticizing the lack of critical details. In short, the event was long on promises, but short on concrete details. Unfortunately, it left more questions than answers. Alright, in case you are new to this channel or in case you don't know, I am a Tesla shareholder, but that doesn't make me a perma bull. I do get critical about the companies that I invest in, and I do watch their fundamentals closely. So am I selling my Tesla shares? Nope, I'm not. But am I adding more shares? I'm not as well, for now. I may still add if Tesla falls further to a more attractive price point. In terms of trading, it's a different story. I am definitely going to continue to trade Tesla almost every other week. It has since become the primary source of my options income, whether is it the wheel strategy or my swing and scalp trades. Anyway, sorry I digressed. Let's go back to the chart. I guess I don't have to tell you that Tesla is looking very bearish with the huge gap down. The question now is, how low can Tesla go and when is it going to stop its rot? I don't have a definite answer, but we can look for some indications. First of all, as I zoom out the chart, I noticed that the last 4 times when Tesla has such a huge gap down, Tesla did not bottom out immediately. The most recent one was in July this year, where Tesla gapped down and fell 12% from 245 to 215. It then went to fall further in the next 1.5 weeks and bottomed out at 182. And earlier this year in January, Tesla gapped down and fell 12% as well, and it took another 3 months for it to bottom out. And then we had October 2023, where Tesla gapped down and dropped 9%, and it bottomed out about 1.5 weeks later. The last one was in July 2023. Once again, Tesla gapped down and plunged close to 10% before bottoming out a month later. So what am I trying to say? I am trying to say that if historical trend is of any indication, then what you saw on last Friday where Tesla fell to 214, that may not be the lowest price point you will see, at least in the next 1 or 2 weeks. But a huge caveat, I am not saying it's 100% certain that 214 isn't the bottom yet, because nothing is guaranteed, and this time could be different. I am merely presenting the fact which some people may not see on the chart. From there, you have to make your own judgment call whether you want to go long or short. So let's say if the historical trend continues, then I would say that there is a high probability for Tesla to retest that 200 moving average at 203. But of course, before that, there is a support level at 216. If somehow this level holds, then it's a sign of relief for the bulls. But if it doesn't, then yes, 200 moving average could be in sight. If Tesla gets to 203 this week, it is likely that the RSI indicator will reach an oversold level, and I may potentially step in to sell a put option, which is a slightly bullish move, in anticipation of a potential short-term bounce. Okay, but just a warning, please do your own due diligence and don't follow me blindly, because this is a risky trade. In fact, I have to watch how Tesla moves before I can confirm my action. Alright, on the other hand, if the bearish thesis doesn't play out and if this time is indeed different from the previous 4 occasions, Tesla may bounce early this week. Couple of things to take note. First up, it will be the 50 moving average at 225. That's the minimum hurdle that Tesla needs to overcome to stop the rot. Then the next target will be the 50% Fibonacci level at 226. Since this level is so close to the 50 moving average, you can group them together. But for Tesla to really stop the rot, it needs to go up and fill back the big gap, which means to hit 232 and don't get rejected. And for us to call Tesla bullish again, simple. Get above the critical 61.8 Fibonacci level at 237, as well as the purple uptrend line. When that happens, then we can say that last week's gap down was just a dream. Personally, I think it's an uphill task, and don't forget that earnings date is coming up in about a week's time on 23rd October. That's one huge event that could swing the stock wildly again, so please be careful if you are trading Tesla recently. Moving over to Google's chart, Google is looking slightly bearish at the moment as it fell below the support level of 164 and MACD just had a bearish cross last Friday. In terms of the downside, there are 3 levels or areas to watch. The first 2 levels are the 50 and 200 moving averages at 161 and 159. If these 2 levels break, pay very special attention to 155 to 157 area. So why this area? Because it appears to me that a bullish inverse head and shoulder pattern is forming on the chart. If Google were to retrace this coming week and bounces off either of the three levels that I have just mentioned, it is bullish. But obviously, on the other hand, if all three levels break, then the bullish inverse head and shoulder pattern could be invalidated, depending on how much Google drops. Anyway, once that three support levels break, I do think there is a decent chance for us to head towards the bottom gap between 151 and 152. Alright, here's my personal take. If Google were to fall to 155 or below, I may consider picking up some shares. Not financial advice, of course. As for the bullish thesis, as shared earlier, if Google can bounce off either of the three support levels, we could potentially have a very nice textbook bullish inverse head and shoulder pattern on the chart. For confirmation of the pattern, Google has to break above the neckline, which is 169. Once it goes above that, Google could really fly. It could be something similar to what we saw for Meta. And when I say fly, I am talking about 190's range. Anyway, even if the bullish pattern is going to play out, it will take time, so be sure to stay subscribed to this channel for future updates. Alright, speaking of Meta, yes, ladies and gentlemen, Meta has finally hit the price target that I set at least 1 or 2 months ago, which is 600. Basically, I have been sharing about this bullish inverse head and shoulder pattern in a number of my videos, and I also mentioned that Meta could hit 600 by the end of 2024. Well, Meta hit 602 last week, earlier than I expected. So congrats to those who have managed to ride the upside and earn some profits. It's your own credit, not mine. And if you don't mind, please give this video a like. Okay, so what's next? Check out the MACD. It is on the verge of crossing down. If we have a bearish MACD cross this week, I think we can expect Meta to break below the support level of 577. From here, there are multiple support levels below, marked by those Fibonacci levels, namely 561, 549 and 536. Honestly, I wouldn't be too concerned if Meta retraces to the 560s or 550s range. But I want to bring your attention towards this particular area, which is between 536 and 542. This area used to be a resistance zone, but have since turned into a support zone. Not just that, it is also where the critical 61.8 Fibonacci level and the 50 moving average are, making it a very strong support zone. And if a strong support zone breaks, it only spells waterfall. In terms of the upside, nothing much to share because it is expected that Meta will be taking a break after a fierce run-up and after the bullish inverse head and shoulder pattern has played out. And while Meta takes its break, it can bounce up anytime from either of the Fibonacci levels, and if it creates another all-time high this or next week, it is anyone's guess on how high it can go. Okay, let's now move over to Microsoft. Microsoft's chart looks interesting to me. If you could recall, I shared that Microsoft is at a pivotal point. And well, it is still at this area, a crucial area formed by the blue uptrend line, the 50 and 200 moving averages, and the 50% Fibonacci retracement level. Let's give this area a range, which is from 413 to 418. I know Microsoft broke below that blue trend line a little bit last week, but not all hope is lost yet. As you can see, it has traded sideways after that big fat red candle. To me, this is a battleground for both the bulls and the bears right now. So who will prevail as the winner? For bulls to win this battle, obviously it has to go above the pivotal area that I have just shared. In other words, above 418. But do also take note that as the day goes by, the blue downtrend level gets higher, so I would say bulls will want to see Microsoft going above 420 to 422 area to declare victory. That's when we can say that the uptrend has resumed. Interestingly, the last two times when Microsoft tested the 200 moving average, it also fell below the moving average for a while before bouncing up. Look at where is Microsoft now. So will it happen again for the third time? We shall see. Anyway, if it doesn't reclaim the 200 moving average soon, watch that 406 level very closely. That's the 61.8 Fibonacci retracement level and it is critical. If it breaks, then Microsoft is bearish, and I do think there is then a decent probability for Microsoft to go below 400. Okay, let's now have a look at Nvidia's chart. Wow, Nvidia looks great at the moment as it punched through the blue downtrend line decisively. In fact, my previous video talks about a bearish dragonfly doji candlestick, and Nvidia invalidated that candlestick by closing above it last Monday. Anyway, I also shared in my last video that if Nvidia can close above 127, then the probability of it going back to 130's range is very high. Well, Nvidia did exactly that. Last Monday, it didn't only close above the Dragonfly Doji, it also closed above 127. And the next thing you knew, we are at 130's range again. And to be honest with you, the moment Nvidia took out the August high of 131, I was expecting it to also retest July's high of 136.1. So last Friday, Nvidia went as high as 135.78, very close. Come this week, I do think this possibility is still there. So let's see if it happens. The moment we go above and close above 136.1, then naturally it opens the possibility of testing the all-time high at 140.7. On the other hand, if Nvidia decides to take a break, be prepared that we could see a fast drop towards 127, where the first Fibonacci retracement level is. There is no need to panic if this happens. It's a healthy retracement if I may put it. If you are holding on to short-term bullish trades, you should only be concerned if Nvidia retests that blue trend line and does not bounce off it. The moment Nvidia drops below that trend line again, it means it would have lost 3 Fibonacci retracement levels as well as the 50 moving average. That's quite bearish. In short, pullback for Nvidia will come eventually, but so long as those key support levels hold, we are good until its earnings date, which is in November. And oh, just to add, this week's earnings report by TSMC and ASML could potentially affect Nvidia's share price as well, so don't get caught off guard if there is a bigger than usual movement. Moving over to the options trading section, I actually don't have any option trade from my wheel strategy to update this week, so perhaps I will just do a quick one for the scalp trade that I took on Tesla after its robo-taxi event. This trade was basically a play of the volatility. What happened was that last Friday, before the market opened, I saw that Tesla was being sold off during pre-market. In fact, the sell-off started since the overnight trading. This was a signal to me that when the market opened, big whales and institutions will be dumping more Tesla shares. True enough, as you can see from this 1 minute chart, Tesla gapped down at the opening with a very high volume. And then on the second minute, there was a very big fat red candle. When I saw that, I immediately sold a call contract, which is a slightly bearish move. Then you can see that the trade was filled at 9:31 PM and 51 seconds Singapore time. As a result, I received a premium of $1,580. But knowing that the first 30 minutes when the market opens is always very tricky and can be a trap, and with Tesla being always so volatile, I placed a buy order right away to buy back my contract with a premium of $1,500. You can check out this screenshot. The buyback order was placed on 9:32 PM and 1 second. That was just 10 seconds after my initial sold order was filled. And at around 9:34 PM and 4 seconds, my buyback order was filled. To summarize, I sold a call contract and received a premium of $1,580, and then I bought it back by paying $1,500, which gave me a net profit of $80 less transaction fees. That's about 100 Singapore dollars for me to spend over the weekend. And all this happened in less than 3 minutes. Well, $80 in less than 3 minutes, I will gladly take it anytime. Alright, some thoughts from me to wrap up this video. We had some decent earnings reports from a few major financial companies. That's a good start to the earnings season. Reason being, when financial industry does well, it's an indication that the US economy is in good health, and that is what a soft landing looks like. It also sets a positive tone for earnings in other industries in the next few weeks. However, at the start of the video, I also shared about something could be brewing beneath the surface, with inflation and unemployment numbers coming in hotter than expected last week. But that said, if we were to take a step back to look at the CPI numbers, it has been trending down over the last 12 months, and it is moving steadily towards Fed's target of 2%. In fact, the latest 2.4% reading is the lowest since February 2021. As for the unemployment or jobless claims numbers, well, what I can say is it is not out of the control yet. Some analysts are attributing this rise in numbers to the hurricane and the Boeing strike. Anyway, 1 week or 1 month's worth of data does not make a trend, so I think there is no need to be too bothered by what could be hidden under the surface for now. The Federal Reserve is still on track to cut interest rate by 25 basis points each in November and December. In addition, it is obvious that the uptrend in the market is still very much intact, as we saw another all-time high last week. To really sum up this video, I just wanna say, follow the old sayings, don't fight the market trend and don't fight the Fed. The market doesn't care about your opinions or predictions. It only responds to the buying and selling actions of the market participants. Which means if the current trend is still up, follow the trend, ride the uptrend. Don't go around shorting the market. Follow the price actions and not your emotions. But of course, if there is a change in trend or if the risk of a downtrend increases significantly, I will be updating you via my videos. So do subscribe to my channel if you haven't, and don't forget to tap the like button before you exit. Thank you.